Picture yourself seated at your kitchen table on an ordinary morning. Your coffee has gone cold beside you. You have just opened an envelope from the IRS, and the words inside it are telling you that you owe a penalty, a significant one. 6% every single year on money you genuinely believed was working in your favor. You stare at that number on the page. You feel something tighten in your chest. You followed every piece of advice you could find. You contributed to your retirement account. You listened to the financial advisor. You even watched videos online that told you the IRS would essentially reward you with over $100,000 simply for investing your money wisely. But not a single person told you about the one rule you overlooked. And now the IRS is coming for that money, with penalties attached. Stay right where you are, because everything I am about to share with you today is designed to make sure that scenario never becomes your reality. My name is Artur, and this channel exists for a single purpose: to make certain that you, whether you are already retired or approaching that milestone, understand the real rules before an expensive mistake finds you first. Now you have almost certainly come across headlines and videos making bold claims that the IRS will hand you $100,000 or more simply for putting money into certain investments. Let me be completely straightforward with you about this. The IRS does not mail you a check as a reward for investing. That is simply not how any of this functions. What the IRS does provide are genuinely powerful tax advantages, deductions, credits, deferrals, and yes, when you apply them correctly and consistently over a period of years, the cumulative tax savings can absolutely climb beyond $100,000. But here is the piece that nobody bothers to explain. Embedded inside every single one of these benefits are traps, and if you do not know they are there, you will not be saving money. You will be owing money. So today, I am going to walk you through 4 legitimate investments the IRS genuinely rewards you for making. I am going to explain the actual rules drawn directly from irs.gov, and I am going to show you precisely which mistakes trigger penalties. Please remain with me through to the very end, because the 4th investment on this list is completely new for 2025. Millions of seniors qualify for it, and the overwhelming majority have no idea it even exists yet. Let me introduce you to Robert. Robert is 62 years old. He continues to work part-time as an independent consultant. He maintains a 401k through his employer and also opened a traditional IRA a few years back. Robert came across a video online that described something called a super catch-up, an opportunity for people his age to deposit extra money into their retirement accounts. The video framed it as the IRS essentially paying you to invest. Robert got genuinely excited. He maximized his 401k contributions, putting in the full $35,650 because he had heard that people between the ages of 60 and 63 qualify for an elevated catch-up limit. Then he contributed an additional $8,600 to his traditional IRA. His thinking was straightforward. More contributions meant more deductions and more savings. But here is where Robert's plan unraveled. His income was too high. Because he was simultaneously covered under his employer's 401k plan, the deductibility of his traditional IRA contribution had been completely phased out at his income level. He had not taken the time to check the IRS income limits. That IRA contribution was not deductible, not a single dollar of it. But that was not even the most damaging part. Robert had also accidentally contributed $500 more than the IRA limit actually permitted. He had not realized the catch-up amount had been updated, and that excess money simply sat inside his account. The IRS assessed a 6% penalty, not as a one-time charge, but every single year that excess remained in his IRA. Robert believed he was constructing his retirement. What he was actually constructing was a tax problem, and the most painful aspect of the entire situation is this. If Robert had simply consulted IRS Publication 590A or used the IRS withholding estimator, he would have known precisely what he could deduct and what he could not. I do not want that to happen to you, so let me take you through all 4 investments the correct way. Investment number 1, tax advantage retirement plans. This category encompasses your 401k, your 403b, your 457b, and both your traditional and Roth IRA. Here are the real contribution figures for 2026, drawn directly from the IRS. The standard 401k contribution ceiling is $4,500. If you are between the ages of 50 and 59 or 64 and older, you are permitted to add another $8,000 in catch-up contributions, bringing your annual total to $32,500. But here is the significant one. If you fall within the 60 to 63 age range, the Secure 2.0 Act introduced what is officially designated the super catch-up provision. You may contribute an additional $11,250 on top of the base limit. That means your total 401k contribution can reach $35,750 within a single calendar year. For IRAs, the 2026 contribution ceiling is $7,500. Once you reach age 50, you can add $100, which brings the total to $8,600. And here is something a surprising number of people remain unaware of. Since 2020, the IRS eliminated the age ceiling on IRA contributions entirely. If you are 70, 75, or even 80 years old and you still receive taxable compensation, you retain the right to contribute. So what is the actual tax benefit? When you deposit money into a traditional 401k or traditional IRA, that contribution directly reduces your taxable income. If you sit in the 22% tax bracket and contribute $24,500, you save approximately $5,390 in taxes in that year alone. Sustain that practice across 15 or 20 years, and those savings compound substantially. That is the legitimate pathway to exceeding $100,000 in lifetime tax savings, but it demands time, consistency, and precise adherence to the rules. The trap? Surpassing your contribution limits triggers a 6% excise tax for every year the excess money remains inside your account. And with 401k plans specifically, if excess deferrals are not corrected before April 15th of the following year, that money gets taxed twice. Once in the year you contributed it, and again when it is eventually distributed to you. One more item worth your attention. If you fall into a lower income bracket, do not overlook Form 8880. The Saver's Credit can provide an additional tax credit of up to $1,000 for individual filers or $2,000 for married couples, stacked on top of your existing deduction. Investment number 2, Qualified Opportunity Zone Funds. This option carries significant power, but it is also the most widely misunderstood investment on this entire list. Here is the essential concept. When you sell a stock, a property, or a business and realize a capital gain, you ordinarily owe tax on that gain immediately. But the IRS states that if you take that gain and invest it into a qualified opportunity fund within 180 days, you can defer that tax obligation. And the longer you maintain that investment, the greater the advantage becomes. Hold the investment for 5 years, and your tax basis increases by 10% of the original deferred gain. Hold it for 7 years, and it increases by an additional 5%, a cumulative total of 15% of your original gain that you will never owe taxes on. But here is where the benefit becomes genuinely compelling. Hold that investment for 10 years or beyond, and you can elect to permanently exclude all appreciation on the Opportunity Zone investment itself. Not merely the original gain, the growth as well, completely tax-free. The One Big Beautiful Bill signed into law on July 4, 2025 expanded these advantages further for rural communities. More than 3,300 qualified opportunity zones have been formally designated as rural zones, and the substantial improvement threshold for property located within those rural designations was reduced by half, dropping from 100% down to 50%. But the traps here are ones you absolutely must understand. First, you cannot simply purchase property in a distressed neighborhood and characterize it as an opportunity zone investment. You must invest through a qualified opportunity fund that files Form 8996 with the IRS. Without that proper fund structure, there is no tax benefit. Second, you must invest within 180 days of realizing your capital gain. Allow that window to close, and the deferral opportunity disappears permanently. Third, and this is the one that catches people completely off guard, the original deferred gain must be recognized no later than December 31st, 2026. That deadline is approaching. The deferral is temporary by design. Only the appreciation on the fund investment itself can be permanently excluded following a 10-year holding period, and you are required to file Form 8997 every single year you maintain a qualified opportunity fund interest. Miss even one annual filing and you risk forfeiting your entire deferral benefit. Investment number 3, Health Savings Accounts, the HSA. I refer to this as the quiet wealth builder, and most seniors either disregard it entirely or fundamentally misunderstand how it operates. An HSA delivers what tax professionals describe as a triple tax advantage. First, your contributions are tax deductible. Second, your money compounds on a tax-free basis inside the account. Third, when you withdraw funds to cover qualified medical expenses, those distributions are also completely tax-free. No other account structure in the entire federal tax code provides all 3 of those benefits simultaneously. For 2026, the contribution limits are set at $4,400 for self-only coverage and $8,750 for family coverage. If you are 55 or older, you may contribute an additional $1,000 on top of those figures. Here is what changed under the One Big Beautiful Bill. Beginning in 2026, Bronze Tier and Catastrophic Health Insurance plans now qualify as HSA-compatible coverage. That expansion means more Americans are eligible than at any prior point. Direct primary care arrangements now qualify as well. And telehealth coverage accessed before meeting your deductible is permanently permitted without disqualifying your HSA eligibility. Here is the element most people never discover. You can invest your HSA balance in stocks, bonds, and mutual funds exactly as you would inside a retirement account, and every dollar of that growth is completely tax-free. If you maximize family contributions, plus the catch-up amount from age 55 through age 65, your total contributions across that decade approach $100,000. Factor in investment growth and the cumulative tax savings on contributions, growth, and qualified medical withdrawals can legitimately exceed $100,000 across your lifetime. But the trap here is a serious one. The moment you enroll in Medicare, including Part A, you are no longer permitted to contribute to an HSA. And here is the element that catches people by surprise. Medicare. Part A enrollment can be backdated by up to 6 months. If your enrollment was backdated, you may have inadvertently generated excess contributions for those retroactive months without ever realizing it. Excess HSA contributions carry a 6% annual penalty. And if you withdraw HSA funds for non-medical purposes before age 65, that withdrawal is taxed as ordinary income and subjected to an additional 20% penalty. 20%. After age 65, non-medical withdrawals are taxed similarly to IRA distributions, but at least the additional penalty no longer applies. You must report all HSA activity on Form 8889 for every tax year in which you hold the account. Investment number 4. And this is the brand new one, the enhanced senior deduction and qualified charitable distributions. Under the One Big Beautiful Bill enacted on July 4, 2025, an entirely new deduction was created expressly for Americans who are 65 years of age and older. If you meet that age threshold, you can now claim an additional $6,000 deduction on your 2025 tax return. If you are married and both spouses have reached age 65, that figure doubles to $12,000. And this is layered on top of your existing standard deduction, not in place of it. Let me translate that into concrete numbers. For a single filer aged 65 or older, the standard deduction for 2025 stands at $17,750. Add the new senior deduction, and you can shelter up to $23,750 of your income from federal taxation entirely. For a married couple where both spouses are 65 or older, the standard deduction is $34,700. Layer the senior deduction on top, and your total protected income reaches $46,700. That is $46,700 of income that the IRS cannot touch. However, there is a phase-out to be aware of. This deduction begins diminishing once your modified adjusted gross income surpasses $75,000 for single filers or $150,000 for joint filers. And if your income exceeds $175,000 as a single filer or $250,000 as a married couple, you receive no benefit whatsoever. This deduction is also temporary by nature. It applies exclusively to tax years 2025 through 2028. Unless Congress acts to extend it, the deduction expires after that window closes. You claim it using the new Schedule 1A for additional deductions. Now let me address the second component of this final category, qualified charitable distributions. If you are 70 and a half or older, you may donate up to $111,000 in 2026 directly from your traditional IRA to a qualifying charitable organization. That entire amount is excluded from your taxable income, and it simultaneously counts towards satisfying your required minimum distribution for the year. You are not even required to itemize your deductions to benefit from this provision. But here is the critical trap. The funds must travel directly from your IRA custodian to the charitable organization. If those dollars pass through your personal bank account, even for a single day, the entire distribution becomes fully taxable income. It makes no difference if you deposit the funds into the charity's account the very next morning. The IRS treats the transaction as a standard withdrawal the moment the money touches your personal account. And if you are over 73 and this represents your required minimum distribution, that taxable withdrawal could push you into a higher tax bracket and simultaneously trigger elevated Medicare Part B premiums through the IRMA surcharge mechanism. One additional limitation: qualified charitable distributions can only originate from a traditional IRA. Not a 401k, not a 403b, not a Roth IRA. Only a traditional IRA qualifies. You now possess a more thorough understanding of these 4 tax-advantaged investments than most financial professionals convey across an entire hour-long consultation. But understanding alone does not protect you. Action does. So here are your 3 concrete steps, and I want you to treat each one seriously. Step 1. Verify your contribution limits before a single dollar leaves your account. Navigate to irs.gov. Locate the cost of living adjustments page for the current tax year. Confirm your precise 401k limit, your IRA ceiling, and your HSA maximum. If you are between ages 60 and 63, verify that you qualify for the Super Catchup provision. Do not place your trust in a YouTube video or a social media post for this information. Go directly to the source, the IRS official website. If you hold an IRA, and either you or your spouse participates in an employer-sponsored retirement plan, consult the IRA deduction limits page on irs.gov. The income phase-out ranges that govern deductibility are revised every year. Making an error here means forfeiting your deduction and potentially incurring penalties. Step 2. File every required form without exception and without delay. If you maintain an HSA, file Form 8889 annually. If you hold a qualified opportunity fund investment, file Form 8997 every year. You retain that interest. If you are claiming the new senior deduction, complete the new Schedule 1A. If you executed a qualified charitable distribution, verify that your Form 1099-R carries the correct distribution code and retain written acknowledgement from the receiving charity. Omitting even a single required form can strip away your tax benefit entirely, or worse, generate an IRS correspondence notice that requires professional intervention to resolve. Step 3. Actively protect yourself from fraudulent schemes. The IRS published a formal warning in March of 2026. Scammers are constructing counterfeit tax benefit calculators specifically designed to exploit confusion surrounding the new One Big Beautiful Bill tax provisions. They advertise enormous refunds. They request your social security number, your banking information, and your date of birth. The IRS stated this unambiguously, and I want to quote this directly: "Any tool that promises a guaranteed large financial payout is almost certainly a phishing attempt. Use only websites bearing a .gov domain extension. If you encounter a calculator online claiming the IRS will deliver you $100,000, close that page without engaging with it. Report it by forwarding the information to phishingIRS.gov. The IRS does not compensate you for investing. What it permits is a reduction in your tax obligation when you invest according to the established rules. There is a meaningful and important distinction between those two things. I want to speak with you honestly for a moment before we close. The rules we covered today, the contribution ceilings, the phase-out thresholds, the filing deadlines, they are revised on a rolling basis, often annually. What is accurate information today may be outdated information by next January. And here is what genuinely concerns me about that reality. YouTube cannot guarantee that my next video reaches you. The algorithm determines what content surfaces in your feed. Notifications get buried under everything else competing for your attention. And by the time you become aware of a rule that changed, the window for acting on it may already be closed. That is precisely why I built something specifically for you. In the description beneath this video, you will find a link to the Global Senior Alerts official WhatsApp channel. When you join, you will have immediate access to a free senior benefits protection guide covering Social Security rules, pension tax traps, Medicare enrollment deadlines, banking protections for seniors, and the precise forms required for every benefit we discussed today. You will also receive real-time notifications whenever a rule changes. No algorithm filtering, no uncertainty, just verified facts delivered directly to you at the moment they actually matter. This is not a sales offer. There is nothing to purchase. This is about ensuring you are never ambushed by a rule you had no opportunity to learn about. Because the government does not arrive at your door to walk you through these things. They post the regulations on their website and expect you to locate them independently. When you miss something, they send you a penalty notice. That is not a fair arrangement, but it is the arrangement that exists. so let me help you stay ahead of it. Click the link in the description, join the WhatsApp channel, download the free protection guide, and share this video with someone in your life who is over 60, a parent, a spouse, a neighbor, a friend from your church or community, anyone who deserves to understand these rules before a costly and avoidable mistake finds them first. I am Artur, and I will see you in the next video. Stay informed, stay protected, and never allow anyone to convince you that the IRS is going to hand you a check. What they will do is allow you to keep more of what you have already earned, but only when you follow the rules precisely and without exception. Take good care of yourself.